What if I told you you don't need to wake up at 5 a.m.? You don't need to track the stock market every day, and you definitely don't need to be a financial expert to build real wealth. In fact, what if the people quietly getting rich are the ones doing the least? Meet Emma. Emma isn't glued to financial news. She doesn't trade every week. She doesn't stress when markets crash. Yet year after year, her money grows. Not loudly, not dramatically, but consistently. This video is not about hustle culture. This is about quiet wealth and how Emma invests just 10 minutes a month using what I call the lazy investor method. Stay with me because this might completely change how you think about money. Introduction: the overwhelm epidemic. Let's be honest, most people don't fail at investing because they're poor. They fail because they're overwhelmed. Too many choices, too much noise, too many opinions. Buy this stock, sell that one. Crypto is dead. No, crypto is the future. Real estate is safe. No, real estate is risky. We live in an age of financial noise, a constant bombardment of tips, trends, and terror-inducing headlines designed to keep us clicking, worrying, and most importantly, trading. The financial industry profits from our activity, not our success. Every time we buy or sell, someone earns a fee. Every time we second-guess ourselves, someone sells us a course, a subscription, or a piece of insider insight. Emma saw all of this and chose a different path. She asked one simple, revolutionary question: what if I do less but do it consistently? That question didn't just change her portfolio, it changed her life. It freed up mental space, eliminated daily anxiety, and set her on a path where wealth became an automatic byproduct of her lifestyle, not a stressful second job. Who is Emma? The relatable blueprint. Emma isn't rich. She's not a finance graduate. She doesn't have insider knowledge. She has a regular 9-to-5 income, monthly bills and expenses, dreams for the future, and, like all of us, limited time and energy. For years, she bought into the myth that investing was a complex game for the sharp-minded. She thought it meant watching intricate charts after work, timing the market based on news cycles, making fast, high-stakes decisions. But every time she tried, she felt stressed, confused, and unsure. She'd buy a stock only to see it dip, then sell in a panic, locking in a loss. She'd hear about a can't-miss opportunity and jump in late just in time for the hype to fade. It was exhausting, demoralizing, and felt like a casino where the rules kept changing. So one day, she stopped. She stopped trying to be smart. Instead, she decided to be systematic. She embraced being lazy in the daily grind of investing so she could be relentless in her long-term discipline. The core idea: what is quiet wealth? Quiet wealth is simple, almost boring in its execution. It doesn't look impressive on social media. It doesn't come with screenshots of overnight profits. It doesn't need validation or applause. Quiet wealth grows in the background like a sturdy oak tree, while flashy, dramatic strategies flare and fizzle like fireworks. It is built on 3 pillars. You remove emotions. Fear and greed are the ultimate wealth destroyers. Quiet wealth systems are designed to bypass them. You reduce decisions. Every decision is a point of potential failure and psychological drain. Fewer decisions mean fewer mistakes. You automate discipline. You rely on systems, not willpower. Willpower is fleeting. A well-designed automatic transfer is ruthless in its consistency. Emma understood one fundamental truth. Wealth is not built by excitement. It's built by boring consistency. The thrill of a lucky trade is addictive but unsustainable. The slow, predictable growth of a diversified portfolio is forgettable but infinitely more powerful. The lazy investor rule number 1: decide once, then automate. Emma doesn't wage a monthly internal debate about her finances. She decided once. In one sitting, she determined what she invests in: a simple, low-cost index fund that tracks the entire market. How much she invests: a fixed percentage of her paycheck treated as a non-negotiable expense. When she invests: the day after her salary hits her account. After that, she stopped thinking about it. She set up automatic transfers and purchases. No monthly debates, no "should I wait until the Fed meeting" questions, no anxiety when the news is scary. Why this works? Decision fatigue is real. Every financial choice you make depletes a bit of your mental energy, leading to poorer decisions over time. By deciding once, she conserved that energy for her career, her relationships, and her hobbies. Automation is her financial autopilot, and it never gets tired, scared, or greedy. The lazy investor rule number 2: simple assets only, the power of ignorance. Emma doesn't chase hot stocks, speculative cryptocurrencies, or complex derivatives. Her portfolio is elegantly simple. Broad market index funds, like an S&P 500 or Total World Stock ETF, perhaps a bond index fund for stability as she gets older. That's it. Her reasoning is bulletproof. Complexity increases mistakes. Simple, diversified assets reduce emotional panic. When one company in her index fund fails, another succeeds. The overall trajectory is upward. Reduce overtrading. There's nothing to swap out. She owns everything, so she's never tempted to jump from one thing to the next. Reduce regret. She never has to suffer the agony of selling a stock only to watch it soar without her. Emma doesn't aim to beat the market. She aims to own the market. Historically, over long periods, the market has gone up. By owning a piece of the whole, she guarantees she'll capture that growth without needing to pick the one winning horse. The lazy investor rule number 3: time in the market, not timing the market. Emma never asks the futile question, is this the best time to invest? She knows something most people ignore, despite all the evidence. The best investors are not the smartest, they are the most patient. Consider this: missing just the 10 best days in the market over a 20-year period can cut your portfolio's final value by more than half. Those best days often come clustered right after the worst days, in the depths of panic. If you're trying to time the market, you are almost guaranteed to be on the sidelines for those critical moments of recovery and growth. Markets go up, markets go down. It's an inevitable cycle. Emma doesn't react. She doesn't see a crash as a disaster. She sees it as the market putting assets on sale, which her automatic purchases will acquire at a discount. She stays invested through every cycle because her system is built for decades, not days. The ritual: what Emma actually does in her 10 minutes a month. Here's the part everyone loves: the breathtaking simplicity. Once a month, on a lazy Sunday morning, Emma opens her investment app, glances to confirm her automatic contribution went through as planned, checks nothing else, no portfolio value, no individual stock tickers. She simply ensures the system is running and then closes the app. Sometimes the market is up, sometimes it's down. It makes no difference to her actions. That's it. 10 minutes. Most months, it's even less. The rest of her month is completely free from financial obsession. She reads, she travels, she works on her passions, she lives her life, all while her financial foundation grows silently in the background. The science: why this lazy method actually works. This isn't a cute philosophy. It's a method backed by decades of financial research. It works because it systematically dismantles the 3 things that destroy investor returns. It eliminates emotional decisions. Fear and greed are neutralized by automation. It reduces overtrading. The buy and hold strategy minimizes fees and taxable events. Studies show that the more frequently traders trade, the worse their returns tend to be. It leverages compound growth uninterrupted. By staying consistently invested, every dividend is reinvested. Every period of growth builds upon the last, creating a snowball effect. Most people lose money not because markets ultimately fail, they have always reached new highs over sufficiently long periods, but because they interfered too much. They are their own worst financial enemy. Emma's genius is that she built a system that prevents her from self-sabotaging herself. The magic of compounding, the silent engine of wealth. Compound growth is the quiet, slow-motion miracle at the heart of this method. It doesn't show dazzling results quickly. The first $100,000 is often the hardest and slowest, but year after year, it accelerates in a way that feels almost magical. Here's the math that fuels Emma's peace. Year 1 to 10, growth feels linear, driven mostly by her contributions. Year 10 to 20, growth starts to curve upward. Her existing money is now earning more money.
Year 20 plus, the line shoots upward almost vertically. The money her money has earned is now earning its own money in a powerful, self-sustaining loop. Emma knows the secret. Time does the heavy lifting. Not effort, not intelligence, not stress, just sheer unwavering time. The paradox: why busy, smart people often fail. Busy, smart people are conditioned to believe that more effort yields more results. They apply this to investing: more research, more analysis, more activity. Emma does almost nothing. She understands the core paradox of modern investing. More activity equals more returns. More decisions equal better outcomes. The market does not reward your attention. It doesn't care how many hours you spend on Bloomberg Terminal. It rewards patient capital, money that is committed, left alone, and allowed to participate in the long-term growth of global enterprise.
If you've ever felt overwhelmed and paralyzed by investing options, afraid of making a costly mistake, too busy with life to manage your money actively, drained by the volatility and stress of financial news, remember Emma. 10 minutes a month, one simple system, zero stress. That's the lazy girl's guide to wealth. And sometimes, doing less is the smartest move you'll ever make.